Whoa, 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 whoa. Yo, what up? What is going on, people? Hold on here. Let me make sure I got everybody in. Bum, 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 bum. What up, Tobias, my man? Gin Bunny. All right. Hold on here. Just waiting on Paul per usual because I always send him the link a little bit late. What's up, people? Oh, yeah. Let me get a little face cream hot. It is hot in Florida. If you're not moisturizing, when you get out sun, you're really in for some pain. All right. What up? Ooh. Jen Bunny, what up with you? I think I've been over applying here. This maybe have gone a little bit bad here. All right. I'm going to make sure Paul gets in here. Dude, then we're going to have fun. Do the Lord's work, baby. Do the Lord's work. Hey, Paul. Hold on here. There we go. There's the Big Daddy himself. Whoop.
Hey, how's it going?
Big P.
What do you guys got going on here?
Tell me, Paul, what is the post-mortem on Klay Thompson leaving the Golden State Warriors?
Oh, you know what? So if you don't know here, I am a huge Warriors fan and love Klay Thompson, one of the big three, right? The one who's been here for all of the championships with Steph Curry and Draymond Green. But I think it was time to go.
Really?
I think it was time to go for him, yeah. He was coming off the bench. He wasn't adapting well to not being the guy anymore. So I think it'll be perfect for him to go to Dallas. And that Dallas is stacked now. They already made it as far as they did. Now they got Klay Thompson.
Sure.
I think that's going to be really good for him. But yeah, it's kind of bittersweet. I think it was good for him to go. But
what do you think though? Like, in the NBA, it's like asset management though. Like those cap holds, you can't trade for somebody good unless you match salaries, right?
Yeah. Right.
So like he had, $40 million salary or whatever. So you can't go and get anybody now either because you let him and Chris Paul go for nothing.
Right.
And they didn't really sign and trade. They did a sign and trade, but
well, they did get they signed a guy. I don't know much about him. Melton. His last name's Melton. I know that.
Yeah. He's a D player.
He's a D. He's a good defensive player, and he shoots like 38% from three. So he fits kind of what the Warriors need.
Okay.
I think they're counting on Kuminga to take the next step now.
Okay.
And he's been playing he played pretty good last year. So we'll see.
All right. So you're okay with this.
I'm okay with it. Yeah.
Would you be more sad if Brock Purdy left?
Brock Purdy. I don't know. I like Brock Purdy a lot. We'll see. I doubt they would let him go though.
Yeah, right now he's cheap.
But we'll see. The key is going to be whether the Niners keep Debo or Ayuk. They're not going to keep both of them after this season.
They can't. Nobody can.
Yeah, right.
That's the thing with basketball and football these days, right? It's like you get penalized for drafting well.
Mm.
Look, the Clippers had to let go Paul. The Warriors actually offered a lot of good stuff for Paul George, and the Clippers are just like, yeah.
Oh, did they? I didn't know. I didn't even know they made a play for Paul George.
They did.
That would have been amazing. That would have been great.
That was the reason that Klay just took off, because he didn't really get much either. He would have got more from the Warriors.
Yeah, right.
He
took less to go to Dallas. He did. It's that weird thing where they're upset at their own team for not offering them as much as they wanted, but they'll happily go somewhere else for less.
Yeah, I know.
Although Texas doesn't have the state tax, so that makes a huge difference as well.
That's true. When
compared to California, which has the highest, some of the highest state taxes.
No doubt. Yeah. Jen Bunny, you know about Debo? Oh, all right, all right. So, guys, welcome. We're on episode 2, and we got Paul back on here because we got a lot of things to finish. So, for those of you guys that are new, Paul is my mentor. He taught me how to trade. Well, I already was trading, but just not successfully when I had met him. And our story, it goes back almost 20 years now, where we met on Google Blogspot, which is still, I think, the best way to do blogs. And, we had become a mentor, mentee since then. And then many years later, I reached out to him because, Bulls on Wall Street was primarily it was a business that was really at the time designed around young men. Because I was also young, but we had a chat room and it was basically 26-year-old degenerates that were day trading small caps. And, there was this whole subset of the market that we were missing out on. And so I reached out to Paul and said, hey, we would like to do something for the swing traders, for the part-time traders, the style that you taught me, because that's the style that he taught me. And so Paul came on, and he has been running our swing trading service ever since. And, he is, he has a lot of good strengths. But I think, his big strength, I've always thought, has been in identifying trends. Identifying trends, like when to be in the market and when to, lay it low. Like, for example, in 2022, in that bear market, he sat on his hands for a good chunk of the year. There'd be, a handful of trades a month or every 2 months. And while everybody was getting smoked out trying to, bottom fish SPACs and this and that, Paul had this one mantra, which was like, hey, just bide our time, bide our time, bide our time. There are markets where you want to be taking on risk, and there's markets where you want to really put your foot on the gas, and we're kind of in one of those right now. Well, maybe not right now, but yeah, in the last handful of months, I feel like this has been one of those type of markets where you would do that. And that's been, one of the things that I really learned from him, because even for myself, when we have a market like this, I step up my risk profile. What I mean by risk profile is, if you're willing to risk X amount per day or X amount per trade, there's certain times where you increase that. And what oftentimes traders do is they increase their risk profile at really inopportune times, terrible times. And it's usually when the market's going down. And it usually starts with, hey, I'm down on a stock, so I average down. I'm down on a bunch of trades, so I increase my risk profile, right? And things get out of hand. And the one thing that Paul's been really good at, and his specialty is, identifying trends. So Paul, let me ask you a question, before we, I got a handful of them for you, but, when you look at trends, how do you define, okay, we're in uptrend, downtrend, this is the time to really lay on the wood, really put some cheese on something, and where other times you're biding your time. And guys, when I say biding your time, when you're swing trading or day trading, just because you're not in something doesn't mean you're not working or actually creating some type of return. I think as a swing trader, sometimes the best things is building out your watch list, building out these focus lists, doing all these things. And it becomes really, really important. And so I think that's where Paul's specialty really is. So Paul, give me an idea, how do you identify these kind of trends? Because I think that's what you're great at.
Yeah, so we have this really kind of formalized process and an approach to analyzing the market. And it's what we do, in our swing service. We do it, almost every day. But starting the week, we always really dig into this top-down approach, which starts with what's the market doing right now? What is the overall market doing? And from there, what industries are leading? Once you have that, you have a good idea of you've done your market analysis, industry analysis, how strong or weak the market is,
Sure.
and what areas are popping. Because it's usually not just a stock that's popping; it's a specific area that's popping. So we start with that kind of top-down approach, funnel it down to then stocks, then the setups we want to take, how aggressive we want to be in terms of our risk and our position building. So it always starts with what is the market doing. So analyzing what we call like the big three indexes: SPY, S&P 500, the Nasdaq, the Qs, and small caps, IWM. From there, we dig in a little deeper because you can look at the indexes themselves. They don't tell you everything. First of all, because they're not equally weighted. So when we look at the S&P 500, there's 500 stocks, but it's not equally weighted, with every stock being worth 0.2 to equal 100%. The top 10 holdings make up over 30% of SPY. So we look at some of the equal weighted ETFs and some other market breadth kind of measures to give us a kind of feel for what's going on under the hood. So right away from there, we have this approach where we basically say we're very bullish, slightly bullish, market neutral, slightly bearish, or very bearish. And I get that kind of overall approach. We'll call it a macro approach from doing that. And then we break it down into the industries. When we get into the industries, we can really see what's moving in the market. And, we may have kind of a weak market, but there's always some sector or industry that's moving. And we try to identify those trends in those industries. So specifically to the current market right now, and we touched on this last week in the first Trader's Edge, while the market, if you just look at SPY in the Qs 2024, the market looks like it's been booming, which the indexes have, but a number of traders maybe aren't keeping up with what the market's doing right now. I just looked up the numbers today for how hedge funds are doing this year, and these are the professionals, supposedly the best of the best, and they're lagging the market greatly. These are the professionals, the Goldman Sachs guys, the Yale, the Harvard institutions. A lot of these guys are lagging the market right now, because even though the market looks like it's booming, it's really only specific areas, and that's where our kind of trend analysis really comes into play, and that's what we've done this year. We've basically made the decision for now, while we're stocking some areas that we think could start popping. A number of areas have been lagging the market. We're completely staying away from them. We've been very concentrated essentially in what's been leading the market this year, which has been big tech, which has been some of the semiconductor AI type stuff, and then some specific stocks that have had good earnings the past 2 quarters for 2024. That's essentially what's been leading the market. If you're trading those, you're crushing it right now. And we have, I think, over our last 20 trades, we've hit on 17 of them. So, even in this kind of consolidation period, if you're finding the right areas, you have an edge and you're winning.
Cool.
If you haven't been in these areas and you're trading some areas where maybe some stuff looks like it's setting up, but they haven't been leading the market, you're probably not doing quite as well right now. So that trend following is obviously really important. Even in weak markets, even in strong markets, it can be really important.
So give me a rundown. Show me some charts. So you mentioned okay, so for the last 20 trades, you've been 17 out of 20 for alerts in our swing trading community. I have a couple questions on some of these because there was a couple trades I really liked that I wanted for you to go over the setups, because I think they're important. I think they're important, and there's something that everybody can do. They're not necessarily crazy complicated. So you're currently in Apple. Apple hit 220 today. You got in around 213 or so. Walk me through, if you could share your screen.
Yeah, let me pull it up here.
And I think it's on the bottom. There'll be next to the camera button.
Right. There we go. All right. Seeing the screen here?
Yep.
Okay. All right, good. So Apple's really interesting because until our recent trade with Apple, we've basically stayed away from Apple. much of 2024. If you look at the trend here, if we just pull it out here, we can see the trend overall. But if we pull up just 2024, you can see, while first let's look at SPY, and we see starting in 2024, SPY has been on this very strong uptrend. Apple was doing the opposite. Practically all of big tech was booming. Apple was not. It was lagging. So that was if we're thinking of our relative strength and trend following instincts, it would be stay away from Apple. And that's essentially what we did. Broke out on earnings recently. That was a good indication. Once that happened, we put it back on our watch list and our focus list. If you go back to our reports, almost every day we were talking about it. We didn't trade it. Maybe there's a spot in here where we could have got long, but we were pretty heavy concentrated in big tech. And you can see it broke the downtrend here on this breakout. So that was a positive. Then we had this huge 2-day run a few weeks ago. And part of the reason Apple had been lagging is every other big tech was talking about AI, what they were doing in AI, and Apple was very hush-hush about that. And there was little known in terms of, and a lot of the talk was they were falling way behind. But this 2-day move here, which was the biggest 2-day move Apple has had in, I think, the last 5 or 6 years, basically all came, nothing fundamentally changed in the company outside of the fact that they said that they were making a deal with ChatGPT for their iOS and that they're developing their own AI in the future. And that got the market really excited. All of a sudden, it's gone from lagging the rest of big tech to leading big tech. So obviously it comes in very strong on our radar. The trends in play, we have a lot of strong volume coming in. Last time we talked about how we really pay attention to accumulation, distribution, volume patterns. We want to see that the institutions are coming into these stocks, especially these big techs, because it's the institutions that are really moving these big guys rather than the low floaters, which us retail traders can have an impact on if there are a bunch of us in it. So volume was very good. We can discount this big gray candle here. Didn't really mean too much. This was related to options expiration, so we can discount that. But overall, very strong. And this was a classic, once we've got the trend in mind, we just don't blindly jump in. It's like we use that macro analysis. We say, okay, the trend's in play. Then we narrow it down, kind of focus into specific setups that we're going to enter in on. They'll give us good risk reward and give us a good edge in terms of win probability. And we got that here on Apple when, we got the big move. We were excited about it, but didn't have an entry to enter in on. Once it showed us here that it was holding the 9 EMA, that's where we entered. So I don't remember the exact number. We entered in here somewhere around 209, 210 as it was testing the 9 EMA. A lot of times we'll take profits at the top of the range, which it's hit right now. So if we wanted to, we could get a nice, easy win right now. We're actually holding on a little longer now. And I didn't even take partials here. I just have made the decision here. The stock is so strong. The trend is so strong right now that we think it can break here to all-time highs and continue the run. And that leads to the concept of letting your winners run, right? Especially when you define a strong trend, which we think there is in Apple right now. There's this tendency to say, you know what, I'm just going to lock in my profit, get that win, and, with the fear that it's going to pull back and you might lose some of that profit. And that's a valid kind of feeling towards a stock. But if you do that, you're never going to hit on those big wins because you're always tempted to take that profit. So you want to be able to hit, 4x or 5x or, even 10x some of these trades, even though usually we're trying to get 2 to 1. You want to hit some of these 4 to 5 to 1 type trades. And our analysis is telling us we can get that with Apple right now.
Paul, give me a rundown. So, theoretically, you would maybe sell at the top of the range. I notice as you've gotten older.
I'm young at heart.
You don't scale out anymore. I know there's a math behind that because everybody, and I think it's really interesting. I think it's something people should talk about. Everybody's just like very focused on scaling out. I sell 1/5, 1/4,
Yeah.
1/4, 1/4, 1/4. And you don't do that anymore. And I noticed this even in my day trading. And I talk to, it depends on the trader and the style that you're doing. But I have a lot of students that have like really, really good win rates. And what they end up doing is, they get in this winner and they sell a quarter and then they get stopped out flatter for a loss on the rest of it. And they're like, damn, if I just took the whole gain at my target, I would have made so much money. And so you play this song and dance where it's like you're selling half, get stopped out flat, selling half, get stopped out flat. I noticed like you're not scaling out anymore.
Right. And that was actually when we, way back when we used to talk about, when we were in that, when I was mentoring you, I did a lot of scaling at that point.
You did?
At that time. And I did it for years. About 2 years after going full time, I did analysis, kind of a deep analysis of all my trades. And what I figured out was overall, over time, I would have made more by just taking the profits at those spots rather than scaling out. And what happens here is, if we just take a look at Apple here, let's say, we enter at 210, we take the profit at 220, so that's a 10-point win there, right? And let's say your risk was 5, so you're getting 2 to 1 on it, right? At this spot, if I get out completely. Let's say I don't get out and I take half off. Now, if it pulls back down, I no longer have 2 to 1, right? I'm going to win at a 1.5 rate, maybe a 1.2 to 1 rate, which over time is not very good. You're not going to make a lot of money doing that. And if I do win on it, I'm winning on it with half the position size. So this thing can go another 10 points and I'm only getting half the R or half of my risk on that. So I basically, it took me 10 points just to gain another half of risk, going from 2 to 1 to 2.5 to 1. And over time, to really overcome that, you have to have these huge wins constantly on that little position you have left. So, it's nice that every once in a while when it really runs and you were still in it. But usually that's not what's happening. So a big adjustment I made was, for the most part, usually take the profit where I like it. So here, for example, Apple at that key resistance level, it's a very defined spot. And what I'll do is I'll keep watching it. And, I could take the profit. This one, I've made a decision that we're going to go for a big win. I'm not scaling. I'm going for the bigger win on this.
Sure.
With a full position size. But let's say we were thinking about scaling here. The better option is take your profit here, take the full profit. And if it proves to you it's going to break that range, let's say tomorrow it goes up to 221, I can always get back in. The trade's not over for me, right? I compare it to football versus baseball. Baseball, you take your pitcher out, you can't put him back in. That's not what trading is like. It's more like football. You take your quarterback out, you can put him back in the next play. And it's the same thing here. Goes up to 221, I can get back in with a full position size. Now, if it goes up another 10 points, I get that 2 to 1 again, rather than just that half R type trade. You give up a little bit, I'm giving up a point to kind of test it here, that 220 to 221. Sure. But I think it's worth doing rather than taking the partial profit.
Now, give me a rundown. So I see traders make this mistake all the time. So I want to ask you about this because I tell them not to, even though, we're taught all in a certain way. You do not. So like a lot of swing traders. So say people don't even know when they're swing trading or day trading, right? It's like if you just have a certain size account or whatever, you buy it. And if you feel like if it keeps going up, you hold it. If it doesn't, they're like they day trade it. It's just no rhyme or reason to it. And I see a lot, and I mean a lot, of new traders make this classic mistake of when they get into swing trades, they watch intraday charts. Sometimes like minute by minute, 2 minute by minute, 5 minute by 5 minute, right? You don't do any of that, right? Like for you, this is strictly on the dailies, the big pictures.
The dailies, it's very automated. My plan is set before I get in the trade. So for instance, since I've got Apple up, we'll talk about Apple again. It's a recent trade. We talked about this the day before that, if it bounced off the 9 EMA, we were going to get in it. And we have a plan in place. I'm going to get in it. You have to adjust it a little bit, but the idea was we get in around 210. We have a certain stop and we have a certain target. It's already laid out before you even get into the trade. So the hard work is analyzing it before the trade. When you're actually putting on the trade, that's the easiest, lowest stress part of the trade. You just get in. It's kind of automated in a sense in your head for you. The hard work's already done. And then basically it is set it and forget it. Yeah, the worst thing you can do is start watching every tick, watch the intraday action. That intraday action is really meaningless to you. And if you do that, you essentially start micromanaging your positions. And again, it's very tempting to get out of good trades when you start watching every tick like that.
I agree. How many times, like when you're new, it's like you turn your day trades into swing trades.
Yeah, right.
And your swing trades, your good swing trades into day trades.
Yeah.
And so you're stuck in this like spin cycle of really never making enough money to cover your losses, because your swing trades you turn into day trades. And why would you turn a swing trade into a day trade? The reason you would turn a swing trade into day trade is because it went up.
Yeah,
And
the only reason you would do that, if your target gets hit in one day, that's great. You can take it that day. But outside of that, you want to just kind of set it and forget it. You have your stop in place, your target in place, and just let it go. If you can, try not to even think about it.
So yeah, a lot of times it's just a psychology. Like you see it go up and you're like, fuck, I could use a win right now.
Right.
And so they sell it. And then vice versa, their day trade goes down and they're like, oh, it's a swing trade.
Let's hold it overnight. Yeah, because
the chart looks good.
Yeah, you never want to turn your day trades into swings or swings into day trades. Apple specifically, look at it 2 days ago. If you were watching every tick and were really beholden to what you were seeing intraday, Friday here was a little scary for Apple, and you might have taken yourself out of what ends up being a good trade. There's very few trades that are just going to go straight to your target without any worry, green the whole way. That's usually not how it works. There's back and forth on the way to that target.
Paul, give me a rundown. Like beyond just having a target, is there anything else that you use to like trail up maybe a stock if it's working in your favor? Like say it's past your target. So like say this Apple gets past 220. I think a lot of times how many traders, especially in a hot market, they look back and they're like, damn, like I could have probably rode this for a few more days. Is there anything else like you can use or you think would be useful to like get out those last bits? Is it like, using an hourly to trail your stop, using a moving average, some level of ATR? Is there anything else you think could help traders like stay in them a little bit longer?
Well, stock specific, strategically, if nothing has changed within the stock and it's going up, there's really no reason to get out. If you start to notice some things that are concerning, for example, maybe the strength of the move is starting to weaken. If your indicators are getting extremely overbought, I'll start to get a little concerned, especially if they're getting overbought and starting to roll over. So, for example, we can look here with Apple. This is our stochastic measure, which measures rate of change. It's starting to hit overbought levels, but we have room before it gets extremely overbought. Usually, 85 to 90 is where I call it extreme. It's at 77 right now, which is a little overbought, but we're okay. If it started to get to 90, 95, and started to roll over and couldn't keep up that pace, I would start to get concerned and consider maybe not going for that 230 or 240 that we've talked about. Now, these indicators can stay very extended. So if it were to hit 90, but is continuing to show strength at that level, I would stay with it. But if it's hit 90 and then slowly starts to drop to maybe 85 or 80, I would start to get concerned, maybe pull out of the trade. The other thing I'll do is look at the past history of the stock. If the stock historically after breakouts moves 20, 25 points, and I'm at that level around 25 points, I might get out because historically it's shown that's the spot where it pulls back. So those are some stock specific stuff. Also look at what's the industry doing. Stocks similar to Apple, are they continuing to run? For instance, with big tech, if I start to notice that big tech has been very strong, Apple's continuing to run, but I start to notice, Google's starting to pull back, Microsoft's starting to pull back, some of these others, that's kind of a clue that maybe Apple's ready to pull back as well. So we can look at maybe some broader industry things, not specific to the stock, to help us decide whether we want to stick with the trade or not.
Nice. What if, so when you say stochastics roll over, so, a lot of times people think overbought, oversold. So it's like a static thing. If you hit 90, you're extreme. If you hit 80, you're overbought. Yeah. When you say roll over, is that in reference to okay, stochastics can stay overbought for a long period of time? So and sometimes it's a sign of strength.
Yeah.
But then when the stochastics roll over, it's
That's a tricky thing about indicators. It's tough to have these really objective, hard and fast rules. You really have to be able to analyze what's going on,
sure.
right? So there is the classic kind of textbook analysis with these indicators, like stochastics specifically. 70 is overbought, and then 80 to 90 you start getting to extreme levels. And the classic kind of analysis is the stock is overbought. At that point, you want to be taking profits. Or definitely don't want to be entering long when the stock is at those levels. But when you're in a strong trend, the analysis changes, and that's what you need to understand. Is this range bound action? Is this kind of a weak trend, or is this one of the booming trends that we love as swing traders? Okay. And if you identify the stock as being in this very strong booming trend, staying at 80 or 90 is actually a good thing. You want to see that, and you want to see it get stronger and stronger. I know it seems odd to say you want it to get more overbought, but you do, because that's confirming the strength of the trend. And if I start to notice price action is continuing to go higher and higher, but all of a sudden this rate of change indicator like stochastics is starting to weaken, starting to go from 95 to 90 to 85, that's a negative divergence, and I'll start to get concerned. And it's a good signal that price is ready to start consolidating or pull back some.
Paul, so if somebody wanted to do this type of trade, but they wanted to do it with options, I know you'd like to throw options in every blue moon.
Yeah.
What do you do? So like theoretically, you're buying this is an earnings breakout, or not earnings breakout, but an APR breakout on the AI announcement. And then you're buying the pullback to 9 EMA. If you want to trade this with options, like what do you do?
Yeah, so I think one of the big mistakes an options trader will make is they'll look at this. It's definitely a stock you want to be trading, and you can definitely use options for it. There's a lot of good strategies you could use, and we'll stick to none of the exotic strategies. We'll just stick to buying calls or selling puts. And I think the mistake a lot of traders make is they don't understand options value and options pricing, and whether they should be a buyer or seller. So for example, with Apple here, obviously you want to be long, right? You want to be bullish, Apple here. Sure. And the question is, how do you go about taking this trade? And I think most people, what they would do is buy a call, right? Apple looks very strong, buy a call. Problem with buying a call here is options premiums for Apple right now are very expensive. So when you're buying a call, you're buying at already expensive levels. One of the biggest factors in pricing of an option is the volatility and implied volatility, essentially what the market's expectation is for the stock going forward. When implied volatility, and later on we can get into the weeds on this, but right now just know volatility, one of the biggest factors in pricing. If implied volatility is high, that's a signal that options premiums are high and you're buying at these expensive levels. And generally, when you want to buy a call, you want implied volatility to increase. And if it's at already high levels, it's very hard for implied volatility to increase. Doesn't mean it won't, and you won't make money off it. But your better bet at this point would be to sell puts in a stock like this. So most people are buying calls. Your win rate is going to be very low. And actually, since we're talking about Apple, I have an example here. Always, when you buy calls, your win rate is going to be lower than when you're selling puts, and those are both bullish plays for buying Apple here. And what I've done here is I've got Apple here. One is buying the call, two is buying the put. Notice here, if you buy the call 1 month out, we have an April 9th expiration.
Sure.
This is a good chart here that shows you the profitability. What we're doing is, this is selling. Let me get to the buying. Here we go. So we're buying at the money at 219, right around 220 here. It's trading at about 220. Buying 10 calls at 738, and you can see here, if we held it to options expiration, the stock is trading at 220. For us to make any money, the break-even point's at about 228. So the stock has to go up 8 points just for us to break even here. So obviously our win rate is going to be a little lower here because the stock could go up to 222, 223, 225. And if we just bought 100 shares of the stock, or in this case, 1,000 shares, we'd be making money, right? The stock has gone up. But we need it to go up a full 8 points in the next month just to break even. Now, if we take selling the put and look at the same chart, so essentially we're doing the same thing, selling the put, the price per option 640. We bought 10 of them. We can see here, this is flipped now. So here, if the stock just stays at 220 till options expiration, we're going to make $6,400, which is the max we can make on this. It can actually go down all the way to 211, so almost 10 points. It can go down, and we're still going to break even on this thing. So that's why we get the higher win rate when we're selling. Not only can it be break even, the stock can actually go down a little bit, and we're still going to break even or win on the trade. And when options premiums are high, meaning implied volatility is high, we generally want to be sellers. And Apple's a good example of that. I think most people are going to come in and buy. And unless this thing really explodes in the next month, you're not going to make much. But if you're a seller, the stock could even go down here to about 212, 214, and you're still making money.
Nice. So that's for you. If the option is expensive, then you're going to sell puts. What is do you have a parameter, like a percentage? Like, how do you consider an option being expensive?
Implied volatility. So the first thing I do is look at implied volatility. There's no hard and fast rule for implied volatility because it's really relative to what the stock has done. So what you want to do is, for example, a stock could be at 60% or 70% implied volatility, which seems high. But if the stock usually trades at 80 implied volatility, 70 would actually be low. So you want to compare the implied volatility to its own history. There's some tools you can use. I think I have them up here. It's a good site here. This is options charts. And it'll give you the IV percentile and the IV rank. These things calculate what the implied volatility has done over the last year. And if these are low, that gives you a good indication that implied volatility is low. So I was actually today in the report, we were talking about entering ELF, and I was looking to trade options with it. And you can see here, the implied volatility and historic volatility seems kind of high, but if you look at the IV percentile and rank, 30 to 38%, so that would be on the low side, we'll say under 50%. So here, whereas with Apple, and let me actually pull up Apple here, Apple's implied volatility, I think, is around 75%, or its IV rank. IV rank 58%, kind of on the high side here. IV percentile 75%, so on the high side. So we are actually, this is Google. Sorry, I think Apple's are very close to the same.
Hey Paul, let me ask you this: now, if all of this stuff, right? If you're short-term trading, say you're just holding for the day, or 2 days, then does it matter?
I don't think it doesn't matter quite as much, especially if you're day trading. You don't have to look at this stuff. You're trading at the money, but that's not what we're doing here. We're holding for trends.
Sure.
So for trends, it becomes very important. Yeah, for the really short-term traders, not as important.
Nice. So do you have? I know you got to go in 5 minutes.
Yeah, I'm heading out for the fourth.
Guys, I'll show you what a couple things. You got a couple favorites coming into this week or next week?
Why don't I just pull up all the stocks we talked about in the report today? An addition to our list is GoGo, and you can see here. If you look at the chart overall, it doesn't look like the strongest chart, right? It's been in this downtrend, but we're starting to see subtle signs of improvement. We think this could be a bottom formation forming. One of our clues is when we get into these stocks that are really beaten down and they're in these potential bottoming formations, if we start to see good volume coming in and kind of a change in character, we can get on these things early. And you can see here with GoGo, It's been in this ugly trend. Notice all of these negative volume candles here. But recently, as it started to consolidate, we're seeing a lot of these big candles. And now we're getting potential for a breakout here over the 200-day moving average. So going into next week, we've eyed this one for if it can get up over the 200-day moving average and kind of hang out there for a little bit. We'll enter. We'll get really good risk reward. We know exactly where we can put our stop. And there's some real potential for this thing to move. GoGo. So when we're watching very closely, we just mentioned ELF. You can see here, ELF has been in just a crazy trend since the pandemic low here. And unlike a lot of stocks which ran out after the pandemic and pulled back, this one has just kept going. So, and if you look at it historically, when it makes a high and it consolidates for a few months and then breaks the high, it goes on these massive runs. You can see here in 2022, it pulled back, a deep pullback, and then it finally broke out here again and went from 34 all the way to 130. Recently, it did that here when it broke out from 136 and went to 221. And again, it's doing that again. It's consolidated for about 6 months here. And now it's tested the all-time high, consolidating in that range. If it breaks here, this 220 range, we're looking to get in here. Watching Google closely here, we do want to see a little bit of a pullback, but very strong trend here as well.
Let me throw out a couple tickers that are interesting. What about, I had this on my watch list today and I didn't trade it. Fuckers. What about this Reddit?
All right, what's the ticker here? I saw everyone talking about it. I didn't even pull it up.
I was posting the swing channel earlier.
Yeah.
I didn't pull the trigger on it.
What's the ticker?
RDDT. It's you were talking about last week, IPO breakout.
Yeah. So I heard everyone talking about it. I didn't get a chance to look at it here. It is on my IPO watch list, and I do have an alert set for this. So what I do is when an IPO, and when I say IPO, I mean a stock that has IPO'd within the last 2 years.
Sure.
Makes an IPO high and then pulls back, which is very common. And these things will pull back anywhere from 6 months to a couple of years, then bottoms out, makes a big run, and finally breaks its IPO high. That's when these things will often make huge runs. So I've got an alert that hasn't triggered yet, but if Reddit gets up here over 75, it'll be a no-brainer to jump in.
Okay.
And I think,
let me ask you this.
Yeah.
Do you think, like, when you get something like this, like say it hits 75, is there the 90 EMA is $10 away?
Right. This is a little tricky because it's made such a huge run to the IPO high. So the IPO is at 75. It was just recently here at 54. I don't like entering breakouts at extended levels. So, beggars can't be choosers, but ideally what I would love, and I think this will happen because oftentimes when they come into these resistance levels, this is what happens, is we see some consolidation here. So what I would love is if this could consolidate for a week or 2 weeks and then break out, that would be perfect. I would be a little concerned if, say, at the end of the week is when we get the breakout here. And the other thing we could look at is, do you happen to know what the short float is on this?
I do not. You can never get readings on the.
Yeah. If the problem with getting readings on short float percentage is they only have to report their short interest twice a month. So at the middle of the month, at the end of the month. So if there's a big squeeze that happens like on the 20th to 22nd, you don't know exactly how much of that is the short float. But if it is extended, but I think there's a short squeeze in play, I might be more apt to enter at extended levels.
I got a couple more here. Now, I was mentioning this earlier in the swing channel. The gap down reversal play has been super hot lately.
Oh yeah.
It's been very hot because of the strength of the market.
One of my favorite plays is when you have a stock that has been in a trend or a popular stock, you get an earnings that the stock gaps down on. And oftentimes these gap downs related to earnings are overreactions. And we saw that in Meta here. This thing gapped down on earnings. It was an overreaction. They barely missed. And you can see here what it's done since. It's just been
Netflix?
skyrocketing since then.
Similar.
Yeah, Netflix, exact same thing. Netflix was interesting because they actually had really good earnings. The only reason they gapped down was because they announced during earnings that they were going to stop reporting their actual subscriber numbers, and that scared the market a little bit. But yeah, it's been on fire since that gap down.
So let me throw 3 tickers at you, then you go do what you do.
All right.
Dell.
All right. Gap down. It actually triggered. So one of our favorite setups is when the gap down consolidates, then breaks into the gap. So you had an entry here right at 145, and it did pop all the way to 160. So you probably would have taken profits in here. Now it's pulled back. I think it's a good signal that it held the 50-day moving average.
Okay.
So I think there's an entry here. And the nice thing about this entry is you have a really tight stop. You can enter at 142, place a tight stop, maybe just under the 50-day moving average, and you could even target the top of the range here. If you were a little more cautious, you could wait for it to break this high here, which you're going to have to wait a little bit. But I think the better play is just to enter now with this really good risk reward. If you lose, you just take a small loss. But if you win, you're going to hit a big one here.
All right. I got one sneaky one that probably people aren't really watching. It reminds me. So MDB, I was posting this in a swing chat.
Oh yeah, I remember MDB was during the pandemic run was one of our favorite stocks.
So this had a gap down reversal just recently.
Topped out, gap down reversal. It did trigger that exact setup we talked about.
I got one similar to this.
Yeah, this setup has been money where they gap down, they consolidate for a little bit, and then they pull into the gap. So here, you would have had a potential entry right at about 245, and it's already run to like 260. Maybe a little extended to enter right now, but definitely would still be on watch.
What about I think it's extended too. SMTC. This feels like
SMTC. All right,
I'm trying to catch one of these bastards. So
I have never even looked at this.
This is a semiconductor stock. It was a hot one too.
So let me pull it out completely because I've never even looked at this stock. So really nice bottom formation here. You have that inverted head and shoulders. Broke out of that. What's interesting here, it broke out, pulled back, and is testing that neckline, and it gapped down right to that level, and is showing strength at that level. So I really like this one. It actually triggered your entry today when it pulled into the gap, and then you could target right up here, right at the 50-day moving average. And remember when we were talking about partials? You could partial here, but what I would do is take profit right at that 50. If it hits that level, keep watching. If it breaks the 50, just get back in.
That one, I've been watching this one for a little bit.
This is a nice one. Yeah, I think I'm going to put this on our watch list.
Well, it's a semiconductor stock, so it got hot real quick. It went from 15 to 45.
Right.
The float is only 63 million. And I'm purposely, at least for my swings, because the market is hot, I'm trying to find some more of the old school low floaters.
Yeah,
that we used to do back in the day, just because the alpha is there right now.
Right. And a lot of these stocks that we were trading that were low floats, because stocks went up so much, the stocks have split. A lot of them have become like 300-400 million float stocks that just a little while ago were 50 to 100 million.
So many stocks were low float and they're like mega floats now.
Right. Well, all right, I got to run. So everyone have a great 4th of July, and we'll do this again.
Hey, guys, I'm still staying on for a little bit. Later, Paul.
All right.
You don't got to do anything. I think you could just log off. All right. Guys, I'm going to stick around for a little bit if you don't mind, because we got some, mostly because I got nothing to do. My kid is I think he's at the beach with mom. So I got some time before he starts hooting and hollering. Old Colt Desai. He is an interesting young man. Well, he's only, 4 weeks old, but he's an interesting young man. You can definitely tell when you see him, he doesn't look like an Indian. He looks like a white boy, but we're hoping that Indian stuff comes in the brain. Being Indian is about what's in your soul. It's about how hairy you are and what's in your brain. So Chrissy, let me get into, I know you were talking about like, the options chains and stuff. So this is what I would do. So, if you're looking at, say, something like Apple, right? I think, I always look at everything from a day trader perspective, right? So when you look at stuff like this, like, for example, this Apple looks like it's going to break out today, right? So this was on my watch list. I fucked it up and I got real. There were so many stocks firing off today. Anybody ever see that? So many stocks firing off that you just end up, you end up getting lost in the weeds and you miss a couple of these. So, if you have something like this that, gaps down, right? So like Apple spikes down at the open and reverses. So like, see this dotted line here? This is the red to green spot. So red to green is just like your reversal indicator, right? Stocks down on the day, goes green on the day. So like what I will typically do, like I will go in and buy the contracts, but just to the next strike price. I'm not worried about thetas and deltas and all this stuff because, frankly, we're short-term traders. So like if you hit this on the red to green, all right, I'm going to buy this candle here. I'm going to put my stop loss right up under here. Now you're into this thing. And now you got the big mamma jamma, right? Now you got the big mamma jamma. So like, okay, you're going to hit this thing at 216. Your entry on the option is going to be like maybe $1.50 or so. And then as a day trader, like what you really want to just be doing is, especially in the morning, just let it ride up its 9 EMA. Once it starts trending, you don't always know if it's going to trend. But once it starts trending, ride it up the 9 EMA till it breaks under. That'll get you the nice chunk that you need. So, you can come in 10 contracts here at 155. It'll cost you $1,500. Try to ride it up the 9 EMA as long as you can. And when it gets out, when it breaks under, you get out. You'll be able to catch a decent little trend on it and have some good cheddars. You don't have to do anything crazier than, thanks, Haywood. Oh, yeah, he's a cutie pie, too. You got the little big chubby cheeks because he's, obviously, he's a big chubby cheeks. He's a cutie. It really is. I'll show him if he walks in, I'll put him up Simba style. Chrissy, does that make sense? Anytime you want to do any of this kind of stuff. So, like, for example, if you were doing, let's say, Reddit, right? Everybody's looking at Reddit. All right, so Reddit has this breakout today. And so the breakout is sitting here. Let's just say, all right, we got the breakout coming in at 68.75, maybe $69, right? So what you want to be doing is like you just go next strike price. You can get cute with it if you want and try to go farther out, but then the math comes in. I don't know about you, but for me, I like being beautiful. Too much math that hurts my brain. So I go next strike price. So we're day traders anyways. So when you start to push through, right? So the breakout doesn't happen till here. So when you start to push through, like you're not going to necessarily buy it right here. You need an intraday pattern, right? So like for example, like okay, you're coming back and maybe you're buying the 50-day. You're buying it at the 50 EMA. Go in with the next strike price, go in. So if you're coming in, if it's at $69, $70, come in and dude, you're going to have yourself a hot hoot nanny. Good. Anybody got anything they want to talk about? Hey, next week I'm going to have Levi come on. He's going to talk about futures. And he's going to talk about options. If you guys are into trading a little bit wilder style than stocks, options obviously is a little bit more wild, but futures is really fun too. We've been doing a lot of futures in his chat room, and dude, he's been crushing some puss on that thing. So I'll have him on Tuesday, and dude, we'll get what we got to do. Anybody got any questions or anything that they want to chat about? All right, all right. Then, my friends, let's be real, let's be fun, let's be fast. Guys, it's a half day tomorrow. Let's not try to do anything too crazy. And we're going to go out and do the Lord's work, all right? I love you guys. Peace. Oh, wait, hold on, Stefano. I just saw these questions. Does Paul take these trades often? Yeah. I mean, he probably takes a couple a week. Stefano, yep. I mean, we're always posting the ideas in the swing room, and he'll alert anything he's personally taking. Good, good, good. Guys, don't forget on Tuesday, Levi's coming, man. He has been, dude, he's the best trader I know. He's been crushing it on options, futures, all of that fun stuff. I'll make sure to send everybody some emails for reminders. And, dude, we'll go do the Lord's work on Tuesday. Maybe we'll bang out some Creed. It's 4th of July. Have some fun. Don't drink any Bud Light. Have yourself a nice Miller, maybe a Coors, the Silver Bullet. You go enjoy your time with your family, and we go celebrate.